Hello, passive listeners, and welcome to another episode of the Actively Passive Investing Show. As always, I'm your host, Theo Hicks, as well with Travis Watts. Travis, how are you doing?
Hey, Theo. Hey, everybody. Happy to be here.
Yeah, thanks again for joining us, and best of your listeners, thanks for tuning in. Today, we're going to be talking about investing in real estate individual deals versus funds. So, as a passive investor, and you're working with a sponsor, is it better to invest in a single deal one at a time or to invest in a fund? So to learn more about what investing in a fund actually looks like versus a deal, like logistically, we have a blog post on the website you can check out called Passively Investing in Apartments, Fund or Individual Deals. We talk about the different types of funds, and things like that. But today we're going to focus more on the pros and the cons of investing in a fund versus individual deals. So before we jump into those, Travis, anything you want to mention?
Well, Theo, I think this is a very relevant topic. I'm asked this all the time. I probably would have had a different take on this 5-6 years ago. My perspective has even changed throughout the years. It's something I'm asked all the time. And, you see a lot of these more maturing companies in the syndication space, a lot of them going towards the fund structure just because they have the reputation, the connections, the deal flow, the ability to raise more capital. So it's definitely worth checking into and asking yourself the question whether it's right for you. We'll try to hold back on opinions, at least until the end, but this is more of a factual pros and cons conversation.
Perfect. Yeah, so let's jump into the first kind of pro or con or advantage or difference between the two, and that would be the time commitment. So here we're talking exclusively upfront. So when you're investing in a fund, you invest your money, and then that fund will be used to purchase more than just one property. Whereas when you're obviously investing in individual deals, you're investing in one property at a time. And so if you want to invest in, say, 10 deals, or let's use 5 deals, you can invest in one fund and invest in 5 deals, right? Without having to continuously qualify multiple deals, qualify multiple sponsors, search around for deal flow, hope for deal flow. You can just say, okay, the sponsor is a fund. They're going to buy 5 deals. I'm going to invest in this fund. And depending on how it's structured, it might be a one-time investment that goes into all 5 deals. You might be able to, each deal comes in, invest an additional amount of money to, be part to increase your investment. But overall, it's more of a, hey, here's a sponsor. He's doing a fund. I'm going to invest, as opposed to, oh, here's a sponsor. Here's one deal. I'm going to invest now. Oh, here's another sponsor. I'm going to invest in their deal, and this deal, and this deal, and having to do all that due diligence, which is, not the same level of due diligence as a sponsor is doing, but still, it's a bunch of, CIMs you need to read, and so there's going to be some ongoing time commitments as well, which we'll hit in a second or later on in this episode. But I think that's kind of one of the major advantages of the fund is that, from your perspective, it's a lot less of a time commitment to invest in the same number of deals.
Absolutely. Great points. I think what I want to cover first is the elements of diversification. One of my favorite topics, one of the biggest reasons I became a full-time LP investor. And I'll share with you a quick story of why that is. A couple things happened in my life in my 20s. One was I had this goal, this overly ambitious goal, that I had bought this single family home that I was living in as an owner occupied residence, and I wanted to pay it off. I found it was a pretty good deal. So I had a pretty low basis in this property. And I thought, man, I'm just going to go hard with this. And, I was hell bent on just paying that thing off. And so when I finally did that and accomplished that, I was, had my little moment of celebration. And then like 2 days later, I thought, what if a tornado hits this house? What if a flood happens? What if this thing starts having foundation problems? It was a 1932 house. It was very old, out in Denver. And I thought, I don't want to have this much equity tied up in one thing. And I got to thinking about the opportunity cost of having that much capital in one place that I couldn't otherwise go invest. And so long story short, I went out and I got a HELOC, a home equity line of credit. I ended up just doing investments instead. And I essentially just remortgaged the house. So, diversification played a big role in that regard. The other thing was, for those that know my background, I had a lot of single family rentals out in Colorado, and I had a lot of equity in each one as that market was driving up rapidly at that point from 2010, 11, 12, 13, 14, et cetera. And I just got uncomfortable with having that much equity in one location in a 30-mile radius, all in the same asset type, And so that led me to discover what the syndication stuff was all about, and the ability to diversify not only your capital, where you're putting 25K here and 50K there and this kind of thing, but in different regions, different demographics, different sectors, different sponsorship groups. So it sits well with me. That doesn't make it right for everyone. Not everyone is of the mindset of valuing diversification, and rightfully so. Some folks have made, multi-millions just focusing on one little niche and putting all their money there. So that's just my take on it. So the first topic here within diversification would be, as I mentioned, your capital diversification, the ability to spread out your risk in terms of your dollars and putting them in different deals. The way I look at funds in the syndication space versus individual deals is, I guess you could draw a parallel to index fund investing in the stock market, where you're buying the index where you have a bunch of stocks in it versus picking your own stocks. And for anyone that's really read through statistics, very few people are successful at picking their own stocks and outperforming the overall market sector. So that's kind of how I look at this too. And I mentioned earlier that if you had asked me about 6 years ago about funds versus individual deals, I probably would have said I prefer individual deals because I want to choose which one I want to put money into. But in my experience, some are winners and some are losers. I didn't always pick the best deals. When a sponsor has 5 deals a year to choose from and I choose 1 or 2, sometimes you get a home run and sometimes you get half the return you were expecting. So a fund allows more of kind of a blend there. But here's another thought too, in terms of a minimum investment. Anyone who's been an investor in the private placement sector knows that a common minimum investment could be $50,000, it might be $100,000, and you're talking about one deal. So, if you go do 10 deals, you might be having to put up $1 million, just to get into 10 deals that way. In a fund, the minimums often are the same. It might be 50K, it might be 100K, but there might be 10 deals within that fund. So you can spread your risk with a lot less dollars. If you do the math there, you might be putting $10,000 into 10 deals, for example. So it's just another way to spread risk. It really comes down to you, how much money you're looking to put to work. If you have $10 million to put to work, yeah, different story, right? But if all you have is 100K, this might be an advantage to you to partner in a fund potentially. And the last thing I'll mention here, well, 2 quick notes. Geographic diversification I alluded to. I like, there isn't one perfect market. And markets are changing all the time, right? Businesses are moving around. People are migrating to different places. The political scenes are changing. So, it's nice to be able to place bets on several different markets that you're a fan of, instead of like I was years ago, all up and down the Front Range of Colorado between Fort Collins and Denver. If anything politically had changed there, or they said taxes are going to double, I would have been kind of screwed, right? So it's nice to place your bets elsewhere. And then sector diversification, what I mean by that is depending on the fund and depending on the sponsorship group, there's different sectors, right? So you could be in mobile home parks, you could be in self-storage, you could be in multifamily, you could be in office and retail, and all these different sectors, which is really nice too, in the same reasons that I just point out. Things change. things evolve, and maybe one day one of those sectors looks a lot better than the other. So it's nice to be able to diversify that way. So that's really, I think, all I got on diversification, but that's the meat of it for me in terms of funds, is being able to diversify.
Yep, that's definitely one of the main advantages. And kind of going back to what you're saying about if you only have $100,000 to invest in 10 deals, or sorry, if you have $100,000 as a minimum and you want to invest in 10 deals, that's $1 million in 10 deals. And kind of going back to the time commitment thing, right? You have to find all 10 deals and hope you pick the right ones. Whereas you can still invest $1 million in 10 deals. It's just now you can do it one time and then just, kind of invest $100,000 and each deal comes in, increase the amount without having to, find the new deal, do a bunch of actually due diligence. So yeah, that kind of plays into the time commitment part. And then obviously, the reduction in risks is also huge as well, because you're diversifying, as you mentioned, across multiple deals. And so as you said, a sponsor has 5 deals. Some are home runs, some aren't home runs. If I pick the strikeout, then I've kind of I'm in a bad spot. So if you invest in those same 5 deals, all of them, right, in one fund, then the home runs could offset the strikeouts or the outperform average, which is good. But it also comes down to not necessarily a con, but a potential advantage. Keyword being potential advantage that investing in individual deals has is the upside potential, right? And so if an investor has 10 deals and 2 of them perform really, really well, and you happen to pick that deal, then you're going to have a higher return than if you invested in all those 10 deals in the fund and 2 of them are home runs, maybe 2 of them were maybe not home runs, strikeouts, and the rest were average, right? Then you would get kind of like the average return. So the really good ones will average out the really bad ones, and you'll get an average return. So again, that's kind of pretty standard though for investments. The less risk involved, then the lower the potential upside is going to be. But as again, it kind of depends on the fund, because if you're investing in a fund where you do participate in the upside on sale, then you're still going to get upside. It's just if one deal does like amazing, you're not going to have like a crazy amazing return, because it's going to be offset by the other returns. And so, as kind of Travis mentioned, it kind of depends on your level of risk. So if you only have $100,000 to invest, and you have it's much less risk to invest in a fund than to hope you're selecting the right deal. Where if you've got $10 million and you're trying to double that money, then taking a portion of that and investing in individual deals might be fine. Something else we have on this list is reporting too. And so I'm sure Travis knows this as well, but when you're investing in 5, 10, 20 deals, especially if they're spread across multiple sponsors, you're getting emails constantly with updates on these deals. The format of these updates are differently. The information included is differently. When you're getting the reporting, the financials for each sponsor might be different. For each deal might be different. Whereas when you're investing a fund, most of the time, the sponsor is going to have just one email for however many deals are in that fund. The format's going to be the exact same every month, every quarter. The reporting to be the exact same every month and every quarter. And I guess that kind of goes back to what I was mentioning earlier about the ongoing time commitment. Are you not having to balance 20 different emails, 20 different investor reports? It's just one email with performance of the fund, any extra information that the sponsor decides to include about maybe the individual deals, but it's still going to be in one location, which is definitely going to save you a lot of time and headache.
Absolutely. One thing I'll add to that as well, you're absolutely right on the emails, hence the actively passive show, right? You get in this thinking, oh, I'm a passive investor. And then all of a sudden you're reading reports and T12s all the time. And one other thing is K1s. This is the tax form you get in a real estate partnership most of the time. And when you're doing individual deals, you're going to get one K1 tax form per deal. So for me, I have a ton of K1s, and every year my CPA just looks at me and hands me a higher quote because it's a beast. You got to keep track of all your basis and your carry forward losses and all this stuff. And I have so many K1s. And so when you're in a fund, depending on how it's structured, you might just have one K1 statement, even though there may be 10 different properties inside the fund. That can be a huge time saver and a cost saver too. So just a side note on that.
Yeah, and kind of on that same note, the paperwork up front as well, right? And so when you're investing in a fund that's going to buy 10 deals, 20 deals, assuming you're telling me you're going to invest one time and then not add extra investment later, it's just one set of paperwork, right? You fill out one PPM, you get qualified as a accredited investor one time. Again, usually it might vary. Right? I'm not an attorney. I don't work for the SEC. It's just generally speaking, the paperwork is a lot less as opposed to having to sign and fund 20 different pieces of paperwork.
Yeah. And with that also is the accreditation stuff. If the group's doing the 506C stuff, you have to be third party verified. And every 90 days, those letters are expiring. So as you're going throughout the year, it's like a quarterly thing. Oh, I got to go get another letter of accreditation again to go do this deal. And, it's a headache, and it is active and it does take several hours of your time. So it's just something to think about. You're right.
And then I think that the natural transition to the next thing we'll talk about, or I guess the last thing we would talk about, which is why do sponsors do funds, right? What are the benefits to the GPs, general partners, and managers of the fund? And one of them is kind of just mentioned is the paperwork, right? And so instead of having to create, an LLC for every single deal and multiple PPMs and all that paperwork, they can just do it one time. One PPM for the fund, and then that's used to buy individual deals as opposed to having to do that each time. I'm sure there's definitely going to be paperwork for each individual deal, but it's much less for each deal when you do it upfront for the fund. And then something else that is a benefit to the sponsor is the fact that since it's a fund, they have a much better understanding, right? Not exactly, but a much better understanding of the amount of capital they're going to have to invest. And so when kind of behind the scenes look here, whenever the sponsors are negotiating deals, one of the things that the sellers want to know, the lenders want to know, the brokers want to know is how are you going to buy this thing, right? How are you going to raise the capital? And so obviously having a track record of closing on deals is important. Being able to show them that you qualify for the net worth and liquidity requirements is important, but the actual down payment, right? Where's that coming from? And you're not going to have sponsors giving you money on an individual deal, or sorry, not going to have passive investors giving you money on an individual deal until it's under contract, until they've reviewed the investment summary, seen the conference call, and then they're going to send you the money. Whereas with the fund, right, you start raising capital sometimes before you even have a deal, right? You might start the fund with a deal, it kind of depends, but you're going to have money in an account so that when you're talking to, you're going to have commitments. So when you're talking to brokers, lenders, sellers, you can say, hey, I've got this much money in commitments already. All I need to do is do the capital call, or if they funded it rightly, it kind of depends on how it's structured. Much more confidence on this from a seller's perspective if the buyer is doing a fund as opposed to having to raise a capital. Because what happens if they can't do it? What happens if something happens and investors don't want to fund the deal anymore? Whereas with the fund, they've already signed the paperwork, and so they might not have actually put the money in there, but they're legally obligated to. From my understanding, to invest. There's also the advantage that comes from that of the revenue coming in to pay the people involved with the fund, right? And so since they're getting the money sooner, they can pay. They can use the fees that they collect from, because usually there's fees collected based off of the amount of money that's invested. these fees can be used to pay themselves, to pay the people on the team that are involved in making sure the fund is maintained. And then one last thing I want to mention, because we kind of talked a lot about how great the fund is. We did talk about the benefit of the individual deal for the upside. Something else that's important too is that you're not going to be like a newbie sponsor doing a fund, right? You need to have a track record. And so funds are good for sponsors who are already established. Whereas, because why doesn't everyone do a fund? Well, they can't, right? But you're just starting out, you're not going to be able to create a $10 million fund. It's more of like a grind on each deal to raise that capital. But once you're established, once you have a track record, once you have a large database of passive investors who trust you, then you can be confident that you can hit that funding goal so that you can buy those deals. So I think that's something that's key, because that's why every single GP isn't doing a fund, because they can't.
That's a great point. Yeah, and that's kind of one of those observations, right? As a LP investor, you see a company that's doing funds or a fund, and maybe that suggests that, right? Okay, you have the reputation, the track record, the experience to pull this off, especially if it's fund 2, 3, 4, 5, et cetera. And yeah, I'm always trying to catch the wave with these groups, so to speak, before they get so big that they're not taking investors anymore. They're relying on their returning investors, or they're going to go public, or whatever they're going to do to take institutional capital, whatever. So I'm trying to hit that threshold where these companies are getting big enough to do a fund, but they're not so big that they don't really need you at this point. So that's kind of a strategy. Side note. So I think overall, I'll bring this up one more time because I think it's important to draw the parallel between the mutual fund, the ETF, the index fund, stock investor wanting the diversification, wanting to participate in the overall returns of the market, versus the individual that says, no, I'm going to pick my own stocks. I know best and whatever, and rightfully so, maybe. And that's kind of what this comes down to, is who are you as an individual, and what is your risk tolerance, right? If you're looking for only choosing the home runs because you think you can identify that, then individual deals make a lot of sense in that regard, as you pointed out. If you're wanting just to, and a lot of people too, by the way, a lot of people investing in syndications are just busy professionals, right? We've mentioned this over and over: the doctor, the dentist, the lawyer, attorney, pro athlete, entrepreneur, they're busy. So if you don't want to take up 12 months of your time working with all these operators and trying to cherry pick the best deals that you can find and all of this, if you just want to say, look, here's $100K, you go do the work for me and I'll, update me monthly or whatever, then funds can also make a lot of sense. As you pointed out, the time commitment element to it. And maybe another great thing you pointed out, Theo, is that maybe a hybrid of the two strategies makes sense. Maybe there's that 1, 2, or 3 deals that are out there that you think, oh man, that just seems so great. I want to be part of that deal. But then generally speaking, I'll just invest in various funds, maybe in different sectors as well. So you're participating in a lot of different ways. So think of those parallels. I think there's a lot of advantages to funds. The more we go through this real estate cycle that we're in now, the more we're in COVID with all the unknowns, the more I personally like the idea of a fund structure myself. But that doesn't mean that that's right for everybody. That's just my take. And as you know, at this point, I really value diversifying. So that's my biggest takeaway. And one last thing I didn't mention earlier about markets, just real quick, is markets, they're changing all the time. Right now, you're seeing like Tesla and Oracle and HP, they're leaving California, they're moving to Texas. Everyone seems to be moving to Texas. Well, that's great right now and for the foreseeable future, but what about in 20 years? What if in Texas they say, well, we've never really had a state income tax, but now we are going to have one, and it's going to be 10%. A lot of people are going to be exiting Texas, So one thing to kind of drive that point home, one thing I always look at is the life cycle of the business plan. And I tend to like these, 5 years to me is kind of a sweet spot. It's much easier to predict what may happen in a particular market over the next 5 years than it is to go into a deal indefinitely where you might be holding it for 20 years. Who knows what the world looks like in 20 years? So something else, it's part of your own criteria that I always talk about. Know your criteria, know your risk tolerance. But yeah, in a nutshell, that's kind of my take on funds versus individual deals.
Yes, and I highly recommend checking out that blog post we have at joefairless.com, Passively Investing in Apartment Fund or Individual Deals, because there are different types of funds, and the funds can be structured in any number of ways. And so it's important to understand not only kind of like the high level overall, what are the differences between individual deals and funds, but getting more detailed on what are the differences between the different types of funds, right? The evergreen funds versus the closed-ended funds. So we go over that in that blog post. And so, we kept it high level here. If you want to go into more details, check out that blog post we have at joefairless.com. And we also at the end kind of give a breakdown of, which of the funds and the individual deals, kind of as Travis summarized, what's ideal for you. Again, not what's absolutely universally better, but based off of what your risk tolerance is, where you're at in your investment career, what's the better investment for you. And I also liked how you said, or you can just do both, right? You can just diversify across, there's diversification in funds, but there's also diversification between funds or between funds and individual deals, right? And so there's multiple ways to get diversification. So I'm glad you added that. So so that's what we have today for funds versus individual deals. Travis, anything else you want to mention before we close out the show?
No, I think we hit it pretty good.
Okay. Well, there's one thing I want to mention. Travis and I are going to start doing a new 60-second segment that we're going to post to the Actively Passive Investing show on YouTube. And we're going to answer your questions. So if you have any questions about what we talked about today, what we've talked about in the past, or anything related to passively investing in apartment syndications, you can let us know by either, the best way would be to email me, theo@joefairless.com, or in the comment section of however you're listening to this. So submit those questions and we will read your name aloud on the show and we will answer that question for you.
All right. Very good. Thanks, Theo. Thank you, everybody.
Yeah. So everyone, thanks for tuning in. As always, Travis, is always great to I guess I always say, get your wisdom on these topics. And best of listeners, have a best ever day, and we'll talk to you tomorrow.